Hey, the S&P 500 hit a new record last night. Yes, it ended at 4239, a new record. Guess what? 2 months ago, right, when market was actually coming down and scouring for shelter, and when the 10-year long bond yield actually went up to as high as 1.77%. Guess what did we say? Look at the next video, okay? Now, bill in the US have gone up even further.
Yeah, it's up to 1.7. In fact, it broke the 1.7% mark yesterday.
Yes, it's actually creep up from 1.625% as of Friday last week when we last spoke to last night at 1.72%. So you're right, Brian, it's the first time they have broken through the 1.7% range for almost 2 years. So the thing is that if one takes a step back, remember last week we mentioned the fact that 10-year Treasury Bill as a reflection of economic recovery is nothing new, right? So we actually draw back the last comparison that was between the autumn of 2016 to the end of 2018, a spate of 24 months. The 10-year Treasury Bill then actually went up from 1.3% to 3.2%, essentially 190 basis points jump. This time around, we actually have from the October last year, the Treasury Bill low was 0.66%. Now we're at 1.72%, which means that we have already gone up 110 basis points.
So now let's look at the underperformance of tech and other growth stocks overnight. Now that resembles a trend basically seen across the world in recent months as value stocks have surged. And we've seen this in Asia as well. Where are investors now putting their money to work?
Well, I think many of the traders essentially, as well as the day traders, the index huggers, so to speak, are moving some of these stocks towards the opening up economy kind of beneficiaries, including your cruisers, airlines, aircraft maintenance companies, the car rental companies, simply because the prices of these companies and these sectors have been heavily hit for the last 12 months since the pandemic actually started. Some of these traders are taking the view that essentially when this economies finally move up and the vaccination level actually goes up, then there will be an entry play into this kind of stocks. So that's why actually the likes of your tech, your REITs, and the interest-sensitive rate sectors are actually suffering in the interim last 2 months, so to speak.
Now, you just mentioned REITs. Now, yesterday, closer to home, Cromwell European REIT proposed a 5-to-1 unit consolidation. The idea, obviously, is to make it more attractive to investors. But what's your view on this?
I find it very interesting because academically, how does a 5-for-1 consolidation, for a Cromwell REIT share actually benefit shareholders? See, how does it actually increases liquidity? In fact, I think it will actually decreases liquidity, as many 5-for-1s, 10-for-1 consolidation have actually shown very clearly. But the fact of the matter is that Cromwell REIT has been expanding too fast, too quick in too short a time. Since its IPO 2.5 years ago, they have actually increased the number of assets that they have in their portfolio from something like 74 to about close to 110, which means that the value of the properties have almost actually doubled or gone up 2.5 times. Now, that is only okay if shareholders were able to participate in the upside, meaning that when they actually go in to participate in the private placements or to actually take the shares at the rights issue. Now, those contributions are able to actually then benefit from a higher DPU from the assets that were acquired. Unfortunately, this is not the case for Cromwell because every time they have to do this, they have to issue shares at a sharp discount. In fact, in my book, the making your millions in REITs, I've highlighted that Cromwell REIT, those REITs that actually have to issue or come to the market giving discount of more than 10% will not do well in the share price, as what Cromwell have actually done. So since the last 2.5 years, there were only two occasions where the share price went slightly above the IPO price of 55 cents euro. And then after that, they have always been on the rate.
Now, Gabriel, looking ahead to next week, with all this volatility that's happening in markets, as an investor, what are you looking out for?
First and foremost, essentially, again, the trend and the pace of how the US 10-year and the US 30-year Treasury Bill move. As we mentioned in your previous program, if we have a case where it's like a 2016 case where, yes, Treasury Bill may move up to 2.5% or even 3%, but if it's done over a pace of 2 years, steady as you go, the markets basically will react quite well. But if suddenly we actually have a sharp jump of close to 190 basis points, as what it happened the last time around between 2016 and 2018, the current situation. So rather than taking place over a pace of 2 years, it happens within 2 months. And of course, you will continue to create havoc in the markets. But then again, for investors, do take a breather, take a step back and ask yourself, why is it that the 10-year is actually growing up so fast? Is it a case where the economic recovery is coming through, which you and I should be happy then,
Yeah.
And because of this sharper than expected GDP growth, then it may then create certain inflationary pressures. But then again, if this inflationary pressures does not, develop into bubbles, then it's perfectly fine, So in fact, I like this kind of markets where in the short term, there are actually
Subscribe to our
shocks
channel.
of
We specialize in
vulnerabilities,
REITs
but for the
and
sharp and
investments,
sagacious
as well as good
investor
market
that
timing
actually
and
watch your
investing.
show